Hi, I'm Pete Andresen with Andresen Associates, and this is the official review of the third quarter. Now, most of the time people say stuff like the stock market went down this much and the bond market went down this or up this much, and fried toad futures did this and that. But we're missing the big picture. And the big picture is that we're in the middle of something big. And we don't yet know what it is, but something big is happening. Basically, things went down a little bit. Our diversified portfolios did not go down as much. That's the third quarter. To paraphrase the Guggenheim Corporation, it was a 3 months spent being patient, which I hate. I hate it. We were patient and we were defensive because we know it is out there somewhere, and we were mildly buying longer term bonds. That was the big thrill. Let me consult my notes. Okay, the thing that's big here is that we had a crash in 2007, and then we had a decade of irrational, excessive stimulus, which drove interest rates to thousand-year lows, multi-thousand-year lows. And that all finished up with a climax, you could say, when COVID happened. In the process, several things happened during this decade plus of historically low interest rates. Number one, we didn't have inflation. That was mostly, I think, due to demographics, exporting everything overseas for manufacturing, and just technology, the improvements of technology. The other thing that happened was a lot of stock market participants, corporations, took advantage of the historically low interest rates to issue this mountain of debt. We've got this wall of debt out there. And with COVID, we had actual money going into people's hands, which created a lot of savings. That eventually having this whole period spawned a period of, I forget what the term is, but it's new monetary theory or something like that, where they think debt doesn't matter. Well, they're about to find out that debt does matter. Excuse me very much. I could be wrong, but basically we have this mountain of debt. Inflation hit, the Federal Reserve had to stimulate to slow the economy down. A little bit behind the curve, but they did what they needed to do. And the result is as follows. Number one, the bond market, of course, coming off zero interest rates, the bond market for existing bonds tanked. Long treasuries down 50%, 50+%. Epic. So that's interest rate risk for you. You could have seen this coming. In fact, we did. We dialed back to short-term bonds so we didn't lose as much, but still it was an epic bloodletting. The other thing that happened was it is having an effect on inflation, but it's about to have an effect on that bond tsunami that we've got out there, that big mountain of debt that's going to need to be refinanced. So is that it? I don't know. The stock market responded by going up, which was incredibly irrational, and is now basically coalescing around 10 stocks that went up around 70% this year and are finally starting to stall out. Whether that continues, I don't know, but the bottom line is that the S&P 500 now has about 30% of its value in just 10 stocks, which is historically an indication that something is askew. The rest of the stock market has performed modestly, to say the least. Meanwhile, international and small stocks have gone into value mode. They're bargains. The reason I haven't bought them yet is that a recession, which still may happen and might not happen, we don't know yet, it might be it, would cause them to become even cheaper. But right now, small stocks are, compared to the S&P 500, incredible bargains. Now, The stock market is just daffy as a two-headed turtle, okay? In the sense that those 10 stocks are just, I don't know where that came from, it's a mania. And they may be right, because sometimes manias are correct. Now, in the third quarter, people started to use their brains, and they started to think, well, maybe everything isn't perfect, and that's why things went down a little bit. Now, we are buying longer-term bonds because a 50% downturn in the bond market usually indicates a recession or at least declining interest rates. But make no mistake, this is a relatively high-risk investment in its own right. The gains are perhaps 20-30% should interest rates reset. That's going up. But it's high risk because what happens if wars or something like that, or deficit spending, or governmental issues push interest rates still higher? Then it gets costly again. Is it the destruction of the bond market as we know it? I doubt it. I doubt anything catastrophic is likely to happen simply because we all muddle by. Well, when something appears on the horizon, instantly thousands of actors, people who are making up their minds, start to do things to attenuate that thing. And so usually the things we think of as crises never quite emerge. So it may not emerge at all, and I might be wrong, and things might go on just fine, which is why we have not totally sold out of the stock market. That's why we're in it. But my take is that that we're in for something. It is out there, in my opinion. Again, I might be wrong. Speaking of patience, today is the 100th anniversary of the founding of the Walt Disney Corporation, one of my favorite stocks because they genuinely did something different. 100 years. The first IPO, the initial public offering for Disney stock, came out in 1940. And if you had been wealthy enough to put essentially an annual wage of $5,000 into Disney at $5 a share, it would now be worth $65 million. But it came with a lot of cost. For one thing, it's down a lot from the high. It's down almost half from the high, and from a recent high. And at one point in the 1940s, it dropped to $3. So patience and courage pay off. And my thought is that if Mickey Mouse can do it, so can we. So patience and courage, just like Mickey Mouse. Blessings.